Hey everyone, and welcome to This Explainer. I am super excited you're joining us today because we're going to tackle something that literally all of us have to figure out at some point in our financial journey. We are taking a deep dive into the world of optimizing your idle cash. Our source material gives us a really solid beginner's guide to a classic financial crossroads, right? Basically, how do we decide exactly where to stash our hard-earned money so that it stays safe, but is also accessible, and is actually growing?
So picture this scenario. You've been super diligent. You've been saving up. Maybe you've got 10,000, 50,000, or hey, even 5 lakh rupees just sitting there. First of all, congratulations. That is an awesome position to be in. But then comes the immediate question, where should that money actually live? Do you just leave it chilling in a savings account, or do you lock it away in a fixed deposit, an FD? It sounds like an easy choice, but as our sources point out, if you make the wrong call here, your money could either end up totally stagnating, or you might find yourself in a really tight spot when an emergency pops up.
Okay, let's dive into this. Because what happens is, a lot of folks unfortunately fall into one of two major extremes. On one side, you've got people who just leave 100% of their cash sitting in a savings account for years on end, and the result? They earn a comparatively low interest rate and their wealth just isn't growing like it could. But then, on the flip side, we have the total opposite extreme. People who put absolutely every extra rupee into a fixed deposit. Now sure, that looks great for the interest rate, but if they suddenly need cash, boom, they are totally locked out and have to deal with a ton of hassles.
Section 1. The Everyday Wallet. Exploring the savings account.
At its core, a savings account is designed for safe, highly liquid storage. You can drop money in whenever you want, and crucially, you can pull it out whenever you want. And that right there perfectly illustrates its main job, friction-free, everyday financial movement. It gives you all those modern essentials we literally can't live without: UPI for quick scans at the store, ATM access for physical cash, debit cards, net banking, the whole shebang. If you've got daily transactions happening, this is undoubtedly your most convenient go-to hub. But, there's always a catch, right? Here is the major trade-off you have to consider. All that convenience, it comes at a price. The interest you earn in a savings account is generally way lower compared to an FD. So if you're keeping a massive chunk of money in here for a long period of time, your savings are simply not growing at the pace they could be. Essentially, you are trading growth potential for instant access. Let's move to and see how this builds in Section 2, the Time-Locked Vault, Understanding Fixed Deposits. All right, now we're looking at the fixed deposit, or FD. The mechanics here are basically the complete opposite of a savings account. With an FD, you take a lump sum of cash and hand it over to the bank for a fixed, predetermined amount of time. And in exchange for you promising not to touch that money, the bank tells you right up front exactly how much interest you're going to earn. And yeah, it's typically a lot higher than your savings account. The best part? Right from day one, you get this huge psychological benefit of knowing precisely what your total maturity amount will be. It is predictable, secure growth for money you absolutely know you won't need in the near future.
But of course, the FD has its own catch, and it's a pretty big one. That lock-in period. Because, well, life is unpredictable. If a sudden financial emergency pops up and you really need to break that FD before its maturity date, there are going to be consequences. Depending on your bank's rules, you're probably looking at a noticeable drop in the interest you've earned, or you might even get hit with specific penalty fees. So yeah, you can open the vault early, but it's definitely going to cost you.
Section 3. The Tail of the Tape. Savings versus FD.
Now, what's really interesting about this side-by-side comparison is how it highlights their totally different jobs across 3 key metrics. First up, access. Savings gives you that anytime withdrawal power, while FDs require locking the money away for a set tenure. Next, look at the interest. Savings offers lower returns, whereas FDs generally give you that nice, higher yield. And finally, the actual purpose. Your savings account is perfectly designed for your daily driver expenses and your emergency fund, whereas an FD, that is specifically for funds you do not need to touch anytime soon.
Section 4. From Face-Off to Tag Team. Finding your balance.
Because here's the thing, the question isn't actually which account is better. These aren't rivals, they're partners in a winning financial strategy. And how you balance that partnership depends entirely on what stage of life you're in right now. Like if you're a student, your main priority is just easy transactions, so a savings account should be your primary focus. Now, if you're a salaried employee, you definitely want to keep your emergency fund in a savings account, but you should seriously consider funneling any extra cash into an FD for that better growth. Business owners, you absolutely need a savings account for daily operational costs, but surplus profits can be smartly moved into an FD.
And if you're retired, well, you need a custom blend that matches your specific cash availability and income plans. It's really all about tailoring these tools to fit your actual lifestyle.
Section 5, Financial Pitfalls. What not to do. Before you run off to reorganize your whole portfolio, let's quickly cover the 4 biggest pitfalls you want to dodge. Mistake number 1, leaving 100% of your money in a savings account and basically stunting its growth. Mistake number 2 is the exact opposite, locking all your cash up in FDs, which leaves you completely vulnerable if you need cash fast. Mistake number 3, opening an FD without actually reading the fine print. You got to understand the interest rates, the tenure, and the bank's specific penalty rules. And mistake number 4, which honestly might be the most critical, completely skipping out on keeping a separate, dedicated emergency fund readily available. So, what's the ultimate takeaway from today's explainer? The winning strategy is not about blindly chasing the highest interest rate, and it's definitely not about hoarding all your cash under a proverbial mattress. The real secret, it's balance and needs-based planning. For most of us, a highly practical approach is just keeping a portion of your cash, specifically that emergency fund, easily accessible in a savings account, and then taking the rest of your surplus money and putting it to work in FDs based on your future goals. It really all comes down to aligning your money with your life. Instead of asking which account is best, the question you really need to ask is, what is my actual need? Are you holding on to cash you might need tomorrow? Or are you building a solid foundation for 3 years down the road? Take a hard look at your bank balances today. Are your funds actually working in harmony with your real liquidity needs? Or are you maybe unknowingly trapped in one of those extremes we talked about today? Thank you so much for hanging out with me for this explainer, and I highly encourage you to go out there and optimize that idle cash.